Welcome to this Bennett Explains finance video. This week, a vital number for financial markets, perhaps the most important number in financial markets in terms of the effect it can have. It's called the US Non-Farm Payrolls number. What is it? Why do markets worry about it? And should you? So, with no more ado, what is it? The first Friday of the month, all attention turns to what this number's going to be. So, from the US, we get this thing called the US Jobs Report, and the non-farm payrolls number is one component, arguably the most important component of that report. So it's all about the employment situation in the world's largest economy, the US economy. So what's in that report? Well, there are three main components. The non-farm payrolls data. This is expressed in thousands of employees, and analysts watch this like a hawk. They try and guess in advance how many jobs have hopefully been added in the US on a monthly basis, or in a really bad case, how many have been taken away. But they're looking for evidence that the US economy is growing, and that comes from the pattern of hiring that you see from this particular part of the jobs report. But it's not the only component, and we'll talk about this in more detail in a moment. There is also the jobless rate as a percentage. So if you're a bull, obviously you want to see the non-farm payrolls increasing. You want to see the jobless rate as a percentage declining. And you'd ideally, depending on your view of inflation, more about that in a moment, you'd like to see average earnings as a percentage on the increase. More about all three comments in just a moment. But just be aware, although I'm going to focus on here for most of the rest of this video, there are actually three at least useful numbers, heavily quoted, that come out of this one report, first Friday of every month. Everyone watches it very closely. So, what is NFP? Well, basically it's called non-farm payrolls for a reason. It's an attempt to capture the, if you like, employment contribution to GDP of the world's largest economies. What it does is it basically says we'll take the number of paid US workers and we'll exclude general government employees, private household employees, and non-profit sector employees, loosely speaking, not because they don't make a very valuable contribution to the well-being of the American economy as a whole. Clearly they do. There isn't a direct link into measurable GDP, gross domestic product, or wealth generation if you like. And then they knock out farm employees. So if you add those all together, hence non-farm, you get roughly 80% of the workers who produce US GDP included. So what's going on down here? Well, the logic is that given that this number is updated monthly, the first Friday of each month, the logic is that with farming as a sector, you get an awful lot of seasonal hiring. And actually, the extent of that would distort the number on a rolling monthly basis too much to make it useful. Hence, the title non-farm payrolls. So not saying that isn't an important sector, but in terms of using this number to draw meaningful conclusions about the US economy, maybe taking out farm payrolls does make sense. Now, why do we care? First of all, it's a US number, and the US is the biggest economy in the world, and it's indicative. It's indicative of what's happening in the US in terms of economic growth, and combined alongside that, where inflation might go next, and combined with that, where interest rates might go next too. So it's pretty key. As the cliche goes, when the US sneezes, the rest of the world often catches a cold, and vice versa. So, impact. Now, remember what I said. In advance of this number actually being produced and published in the US, analysts try and guess what they think it'll be. And they usually come out, obviously, higher or lower than the actual number. So, higher than expected will tend to, now this is just a rule of thumb, will tend to push up the dollar because more people being employed in the US, a lower jobless rate would tend to suggest that employers are feeling confident, business is picking up. You don't hire someone normally just to fire them straight afterwards, so that's good news. And the dollar is the kind of bellwether for the US economy. So it will tend to strengthen the dollar. Government bond yields will tend to rise, potentially because alongside a strengthening of the US dollar, stronger economy, analysts will tend to anticipate perhaps a rise in interest rates, and that has a negative effect usually on fixed income bond prices, because the expected return diminishes if you think interest rates are going to increase. More about that in other videos, by the way, on fixed income securities. The stock market will often rise. I'll say often. We've been in a strange situation fairly recently where stock market's been heavily driven by central bank activity, expectations of interest rate rises, when they're going to happen, will they happen, and or the opposite, which is central banks trying to pump money into the economy by quantitative easing and cutting rates. So that has a driving effect on stock markets, but broadly speaking, if you get higher than expected data, that suggests confidence in the US economy, so you might expect stock prices to rise, but I'm certainly not guaranteeing that will happen every time. And commodities may also rise. People are thinking US employers more confident, businesses doing better, hiring, that'll tend to drive future demand for the stuff they need to make things, i.e. commodities, copper and the like. Now, the corollary, if you like, the reason why I'm hesitating on making too much of a definitive comment about stock markets, commodities, is that if non-farm payrolls come in very strong, way above what analysts have expected, then there's a possibility the central bank, the Fed, will step in to do something about it, to cool things down a bit via interest rate rises. More on that in a moment. Now, lower than expected. So the actual number comes in below what analysts have been forecasting as they watch this area like a hawk. That'll tend to weaken the dollar for the inverse reason I just talked about, good numbers strengthening the dollar. Government bond yields will tend to fall, okay, rather than rise. Stock markets often fall, but they don't always fall, because people might think, well, hang on a minute, if non-farm payrolls are on the low side, maybe the central bank wanted to do something to stimulate the economy, and maybe that, ironically, could act as a boost to stock prices. But all other things being equal, you might expect stock prices to cool off a bit, and equally, commodities may often fall, but I can't be any more assertive than that. I certainly can't say they definitely will. And bear in mind, if the non-farm payrolls number, which is crucial to the US economy, is very weak, you may see interest rates being lowered, and you may also see more stimulus measures likely. And of course, the Federal Reserve is always trying to anticipate this number, just like everyone else, to get their monetary policy right. Now, just to finish off, what is the relationship between something like the non-farm payrolls data and interest rates and inflation? Very crudely, here's a summary for anyone who's new to this stuff. If the economy is slowing, indicated by weak non-farm payrolls data, not just 1 month, probably several months of weak data, then inflation is likely to drop on average because firms are contracting, there are fewer people in employment, less money to spend and so on. So the Fed will tend to lower interest rates in response and or embark on stimulus measures like quantitative easing if you're talking about central banks. The idea is the cost of borrowing then falls to consumers and businesses. It makes borrowing cheaper. That means firms are more likely to be able to borrow to invest. Consumer spending is also likely to rise. Okay, not necessarily in strictly this order, but you get the idea. That is expected to lead to economic growth, and one way of picking that up is stronger NFP data. Eventually, that's going to result in more people in employment, more business confidence, in prices starting to rise. That's going to tend to push inflation up, and at a certain point, the Fed will think, well, we don't want inflation to get run away, we don't think they get carried away themselves. So at a certain point, a central bank that's looking at inflation, some look at it more than others, might think, let's do something, let's step in, raise rates or cut stimulus, whatever it happens to be. And eventually, you could say it's a circular thing. You might get back all the way to square one and start the circle again. Very brief guide there to how the 2 or 3 factors interrelate. Lots of ground covered. Short-term investors therefore tend to worry about non-farm payrolls. Short-term investors in currencies, bonds, shares and commodities will tend to sweat first Friday of every month and react. As a long-term investor, be careful. It is a number that attracts a lot of noise, a lot of newspaper coverage. All right. It is indicative of where the US economy is in the cycle, and it does have a bearing on, at least short-term, the direction of certain key asset classes. But historically, it's not a definite indicator of the future direction of stock prices. So be careful just dumping stocks because you've got a weak non-farm payrolls number or piling in something on the back of one strong one. It's the underlying long-term trend that matters. Any questions? To the usual place, please.